there have been many other big AMCs which were doing really well on mutual fund side, and they aspire to do great business in the space of alternatives. But in the very first 2 3 years, they had to actually change their strategies. But it seems that SBI has actually deep dived and understood, and you guys were waiting for long to see what is working, what is not working. And now, when the space looks to be really conducive and kind of things are more clear, and in that context, my question to Mr. DP Singh, that when you initially kind of very confidently claim that, like SBI Fund Management is today a very well-known and thought leader in the space of mutual funds, there is a big vision with regards to the space of alternatives. So leaders shape and execute the vision, and you are a leader managing as a chief business officer the space of alternatives as well as mutual funds for SBI as SBI Fund Management. So it would be good to hear it from you. What have been your learnings in the past, and why do you say that so confidently that over say next 3 to 5 years, SBI Fund Management is going to be leader in the space of alternatives? We have three very important guests today from the team SBI Fund Management. One can understand SBI Fund Management has been doing really well with regards to their mutual fund business. But as the alternatives industry is growing, SBI Fund Management has been doing very fine, and I would say work in their silence in the space of alternatives. There have been some well-known PMS and AIFs we have also done for our clients. We know that, but I know that industry doesn't know too much about it. And this session is all about trying to understand from the thought leader from mutual fund industry, which is SBI Fund Management, that what are your plans and what is your vision with regards to the alternative side of the business.
Thank you, Kamal. Thank you very much for having us on this very, very important webinar. So just to give you a perspective, see, we as you said, that today we are leaders in the mutual fund business, as far as, because everybody keep on watching the numbers of and AUM, so on and so forth. And today we are managing around 6.5 lakh crores of AUM on mutual fund side, and we are around 2 lakh crores ahead of the second player in the market. So having said that, see, when we were doing it, at the same time we were preparing ourselves with our alternate journey. And as we see globally, when we look at the large players like BlackRock and others, if we talk about the BlackRock as a overall player, their total business of around $20 trillion, out of which around 11 trillion is in the alternatives and 9 trillion is around 9 trillion is in the mutual fund space. So as is globally that the alternatives and the asset management business are higher, much more than the mutual fund business. We also know that the way Indian economy is doing, the way we are working, the same thing is going to happen. And today, very happy to share with you. I think a few of you will be aware about it. Today, we are around $200 billion kind of 200 plus $220 billion kind of business which we are managing, and out of which our the mutual fund business is around 90 billion, 85 to 90 billion. Remaining is in the PMS place. But this majority of this, around 96, 97% of this is in the institutional side, the major institutional player. And the second is in a few thousands. So we have already established our leadership in the alternatives through the institutional space. But now we are very, very serious about the alternate business and on the PMS, on the AIF side for all our ultra HNIs, corporates or businesses or HUFs, so on and so forth. Because we know that India is following the footsteps of all the other developed economies, and today the way we are operating as an economy, so it's sooner than later kind of position. So what we have done in our organization, because we also are aware, though in our country, we have seen the PMSs were being handled by individuals and or very small organization or entrepreneur-run organizations. But ultimately, when you talk about the big number, the scale matters, the institution, the brand definitely matter. So we were very serious about it, and very recently we have started the process. We have a separate chief investment officer for the alternates. We are having very huge aspirations for ourselves in the gift city. We have already got the products approved from the authorities, and we are sure to be in every aspect of alternate business. It could be alternate category 2, category 3, or later on be category 1 also. We already are running successful, very small businesses on the PMS, but that was basically to do the dipsticks, to understand the nuances of the market. And very steadily, we are moving towards a big business. We started very slowly, but steadily we have to be the winner. But we know our responsibilities. So that's the aspiration, I think, in next 3 years we will be the largest player in the not only in India but and some when I say we means our India operations as well as Gift City operations will be a major player to reckon with, and we want the best products to be made available to our clients. So that's see basically is our thought process. So that's what it is, Kamal.
Right, Mr. Singh. This is very encouraging to hear this, because I can tell you, we are one of the leaders in terms of online platform. I conceptualized it in 2018 while I'd left, my career with Citibank after having worked there for 10 years. And there, obviously, we were dealing only with HNIs and ultra HNIs. And I could see that the industry in terms of products need to transform from conventional products to the complex structures of alternatives. And though these simple structures like mutual funds were kind of understood by most, but the complex structures were kind of least understood, and that is where we thought let us start this platform PMS AIF World. And I really kind of see a lot of practical possibilities in your vision. And many other AMCs have been kind of following the same steps. So now my first question, I will just try to moderate this session from practical perspective. Like you said, that not only you are having vision to become the largest player in terms of alternatives, just like you maintain your leadership in mutual funds business, but at the same time you have deep dive this space and you want to bring good products in the from the perspective of investors, because that is actually I think which is an area where people may feel there is a competition, but I think there is no competition, because there is scarcity of good products, right? So from that context, I would want to start first from the debt side by asking questions from Mahesh, and to everyone who's logged in late, I would just give you a background to Mahesh. Mahesh is a chartered accountant and a CFA, and brings with him 23 years of experience, and he has worked towards the debt side in various roles in the past. And over last 23 years of experience, he has in-depth experience of managing the credit side. And that is where I would want to understand from Mahesh first, that what is it that you are kind of conceptualizing in terms of products which SBI Fund Management is wanting to launch in the space of alternatives from the perspective of debt side of a portfolio management. Unable to hear you, Mahesh. I think you're on mute.
Yeah. Is my voice audible?
Yeah.
Yeah, sure.
It's audible now.
Yeah. Thank you, Kamal, and good evening, everyone. So the kind of funds that we are looking at, especially is on the IFSC Gift City. And as you rightly pointed out, we are looking at the various issues that would come up in the capital structure, right from the sovereign AAA kind of and of where we can get value in terms of some government guaranteed bonds which are there. We are looking at capital structure, which is tier 2 bonds, market linked debentures, which are down the credit curve. So mutual fund business as such are able to take certain securities which are permitted and which has got a lot of liquidity in the market. But when we look at certain names in the credit space, we look at names which are having good name but probably might have lower liquidity, but at the same time gives you good carry in the portfolio that you would like to take. So that could be so in the GIFT City specifically, what we are planning to work on are on IFSC listed bonds, on certain foreign currency bonds, which will carry a natural hedge in the portfolio. Apart from that, depending upon the situation, we could also take some tactical calls on even convertible bonds if they are available in the bonds, and which will actually give a good dollar return to the investors.
Sure, right, Mahesh. And what are the timelines, for SBI Fund Management to launch this AIF? And are there any products which are already running? Because I am aware of, one of the Category 2 funds which had raised money, I think last year. So would you want to give some perspective to this part?
On the the funds which we are planning to launch, the one which I said is the IFSC GIFT City. So this is going to be a Cat 3 AIF open-ended fund, and it would be for continuous participation for the investors. The reason being that being in GIFT City, this fund would have no tax in the hands of investors under the Indian regulations. There will be no restriction on repatriation. Because this fund will be given an FPI status for investing into India, and NRI, for all you know, participation would be up to 49% of the fund size. So this fund, since it's going to be a Cat 3 and under IFSC, this will not have any sectoral, say, exposure limits, or neither would have any geographical limits. So it gives you a lot of room to choose the best which is available, and you can do a lot of strategic and tactical calls over there. You can take interest rate views, you can work around the sovereigns, the AAAs, which will give a good carry. And if you want to implement your interest rate view, we also have the option of using interest rate swaps and convert the liquid exposures which we have in the 5-year, 10-year paper, or even a AAA kind of a bond into something like a 6-month, say, overnight rate, or a 1-year overnight rate, which looks to be more attractive over here. So there are a lot of say, which can be implemented because here we can not only look at the credit part, we can also look at the duration part. So it has to be a combination of credit and duration, and at the same time look at the liquidity the underlying issue would get in, and how all this fits into the ratings, and what kind of overvaluation or undervaluation these spreads give us, so that we can form the portfolio based on various factors.
Sure, this is quite interesting. I think, I have not seen any product in Category 3 which is trying to do this. And I think this is the real use of alternative strategies. So this is going to be a disruptive product, and we will look forward to the same. Over to you, Gaurav. I would like to hear from you. What are the equity side of innovations that SBI Fund Management is kind of conceptualizing? And to everyone, I would just give a brief background to Gaurav. Gaurav brings with him 15 years of experience, and he has been working as equity analyst. And currently, very recently, I think in the month of October 2021, he has taken over as CIO for alternatives business at SBI Fund Management. In the past, he has worked with Ambit Asset Management, with Edelweiss, and he was the one who had pioneered popular PMSs at Ambit. So Gaurav would be handling the equity side of alternatives business at SBI Fund Management. Like Mahesh would be handling the debt side. Over to you, Gaurav. Would want to understand from you, what is it that SBI Fund Management is conceptualizing in terms of equity products?
Hi, good evening, everyone. Kamal, first of all, am I audible?
Yeah, very much.
Voice clarity is fine, right?
Totally fine.
Perfect. So, good evening, everyone. I think, before I get into what we are thinking on equity side on the alternatives front, I think one brief context. If you look at the global asset management trends over the last several years, I think there are two categories which are very clearly.
Sorry to interrupt. You could, what you could do is you could maybe switch off your camera. That will improve your quality of voice also, and will reduce the perfect.
Okay, is it better?
Absolutely.
Perfect. So I was, just sort of starting with some global context. If you look at the global asset management trends over the last decade or so, I think there are two things that very clearly stand out. A, passives are gaining massively at the expense of active, and B, alternatives are gaining massively. And if you think about these two trends, they would appear counterintuitive because on one hand there are these passives where people don't want to pay a fee and they are very sort of happy to get index performance, and that end is gaining significantly. But then at the other end, alternatives where usually globally fee has been a little bit on the higher side, and these are securities that largely are illiquid. Some of them are unlisted, and that's also one segment that has gained quite comprehensively. And if you think about these two, they are not necessarily at odds to each other. I think what investors are saying is that in large liquid names where price efficiency is quite high, there is no point paying a fee, and we are happy to sort of get passive performance there. But at the same time, in illiquids where the ability of the active fund manager to differentiate from the crowd is higher and the ability to generate that alpha is higher, they're very happy to sort of pay a fee on top of it. I think as SBI Funds Management, what we are also sort of intending to do through the alternatives piece is to get more and more differentiated exposure to that illiquid end of the spectrum. That could sort of start with a lot of these listed ideas. And just to give you some context, right, there are some 1,000 companies today in India which are above 1,000 crores of market cap. But if you think of what a typical mutual fund industry does, and that's sort of they're probably constrained by their asset sizes, and that asset size is only gaining over a period of time, is that about 85 to 90% of all mutual fund industry AUMs are largely concentrated in the top 250 stocks. Top 250 stocks are what the SEBI classifies as large and mid cap stocks, right? So anything which is small cap or below gets very little sort of AUM from the asset management industry, and that's largely a function of the fact that their AUMs are so large that they can't sort of build any significant exposure to these names. And which is where I think something like alternatives becomes interesting, because you can not only gain exposure to these names, the relatively sort of small and mid cap, micro cap kind of names, but you can also sort of build concentrated position sizes, so you can express these ideas very frequently. So while a mutual fund scheme will have 1.5% exposure to a relatively liquid small cap idea, you can express the same in an alternative side, to a much higher degree by expressing it as a 5-6% position size. So I think that's one key advantage. What the alternatives piece also allows you to do is to look at the entire sort of investing piece from a pipe lens, right? Which is that you are investing in publicly listed ideas, but having a very private equity kind of mindset to it. So in that sense, you are able to sort of generate. So in that sense, you are able to sort of express yourself in these mid and micro cap names, and then buy 4-5% positions in them, and then ideally sort of hold them for next 5, 10, 15 years, and see their journey from being small and micro caps of today to mid caps of tomorrow, and logically large caps of day after. So I think that journey is what eventually, generates long-term alpha, very different from what you see with respect to large-cap indexes like Nifty. And I think that ability to generate that return is what will eventually differentiate alternative offerings from, your relatively sort of plain vanilla offering like mutual fund products. The second advantage, obviously, is that your ability to sort of be very differentiated with respect to targeting specific themes and meeting specific client requirements is also that much higher in alternatives versus mutual funds, which are typically constrained by SEBI classification on what kind of offerings that you can have. So that's one piece. The second piece, which is that you can have a pipe like investing, very long-term driven, very exploring businesses when they are relatively younger, and then sort of seeing them fructify into large caps and blue chips of tomorrow. The second aspect I think that alternatives offers, which is very differentiated from the mutual fund side, is that your ability to express asset allocation is also very flexible here. So AIFs, as you all know, you can go up to 2x leverage. You can also short. So theoretically, in times when the markets are too exuberant and everything is frothy, you can, in no time practically bring down your net exposure to zero or even go short if you wanted to. And similarly, when markets are too attractive and too cheap and there's blood on the street, I think you can also use the same leverage to get long exposure to the extent of 100% plus. And if you think about this, if you can combine the first piece and the second piece, which is that a pipe like investing approach with your ability to be very nimble on asset allocation, then not only can you see the benefits or the non-linear returns on the way up through participating in these relatively smaller cap ideas, but also through an overlay of, let's say, Nifty futures long or short, you can make sure that your drawdowns are pretty insignificant compared to even large cap indexes like Nifty. So these are some of the advantages that you see on the alternative side, which conventional mutual funds can't exploit. And then the third piece, I think, which is equally important, is that you can also sort of express the fee option very differently here, and you can ensure that not only is the client interest paramount, but you can also make sure that your interest and client's interest are aligned so that there is no conflict of interest. In fact, we've very recently launched a PMS scheme where we are only charging a performance fee on the alpha that we generate over the Nifty 50 TRI. So in a way, what we're saying is that our job is to generate alpha for the client, and anything which is beta, which is market return, we are happy to offer it for free. And we're happy to be compensated only if we outperform the benchmark index year after year. If we don't, please don't pay us. So I think those are some different ways and shapes and forms in which we think that alternatives can create much larger value for HNI clients, and that's what makes us so excited about this. These are some thoughts that we have today as we graduate from a conventional asset management house into a full-fledged house that also offers alternatives. But as we move forward, I think unlisted and pre-IPO and those kind of opportunities will also become a significant portion of the alternatives offerings. But those are the initial thoughts that we have at this point in time. And to the extent that all of this is coming from the SBI ecosystem, not only helps from an investor trust point of view, but I think it's also very important because as a large asset management house, we have access to the entire ecosystem when it comes to doing our due diligence on the investing companies. So management access is only the starting point, but sort of trying to touch base with the entire ecosystem on the company side, whether it's the dealers, distributors, vendors, customers, employees, ex-employees, etc., becomes that much easier. And I think that allows us that edge to buy relatively undiscovered names and then sit with them for the next several years. And not to the last point to add there is that we also do a lot of work on the sustenance of these businesses. We have an in-house ESG team in place, which makes sure that these businesses are not fly-by-night operators. They are making sure that sustainability is completely ingrained in their business processes. We also run a forensic accounting framework that helps us look through the reported numbers to see whether management interests are aligned with minority shareholder interests and or not. So there's a degree of rigor that goes into not just looking at the usual aspects of identifying the business, but also going a step further to say that is the business performance that you're seeing today sustainable into the future as well or not. So I think in that sense, we are very sort of very excited where the alternatives piece allows you flexibilities on pipe style investing, on asset allocation advantage, being expressed more freely, and then sort of offering fee structures which are very conducive for the clients.
Right, Gaurav. I remember, when Ambit had launched Good and Clean product, I remember, watching you, I think on one of the news channels during those days, and hearing it out from you now, being part of SBI Fund Management in terms of the innovative alternative strategies, the way you have explained, kind of, makes me very confident in terms of asking this question, which is a little difficult question to ask you, that why is it that you want to kind of work towards a long short oriented strategies with regards to investing in the space of small and micro caps, if my understanding is correct. Otherwise you can correct and explain the product structure. You have explained the opportunity that you're trying to tap, but the product structure is something which I have not been able to understand. Can you please explain that little, maybe more simply for our audience to understand the context of the product being kind of conceptualized?
Right. Thanks for asking that, Kamal. And we have, let's say, these pipe-like strategies also on the PMS platform where we don't really run a long-short strategy. But I think one thing that we all need to sort of appreciate is that while it's very easy for me to say that buying a relatively smaller cap idea today, doing my due diligence on it, and then making sure that I sit with that idea for the next 3, 5, 10 years will hold me in significantly better stead than those who are only investing in large and mid cap names. But I think what also needs to be remembered is that in situations when market liquidity dries up and when certainly people turn a lot more pessimistic, I think some of these ideas also tend to, just because they are smaller today and illiquid in nature, they also tend to show some stock price volatility in the interim. Now, this stock price volatility is something that long-term investors, discerning investors, differentiate from business volatility, because a lot of these names might be doing the right things with respect to their business processes, and they might in fact be sort of navigating the challenging macro much better than even some of their larger cap peers. So to that extent, just being small doesn't mean that your business processes will also see the same kind of volatility as from a macro environment point of view. But from a stock market point of view, we do know that in times of carnage, just because of these names being a little illiquid, they tend to sort of suffer a little more. So I think long story short, the limited point that I'm trying to make is that while these ideas are very remunerative from a longer term investment horizon point of view, in the near term, stock prices may offer a little more volatility versus, let's say, something like the Nifty or a large cap index. And which is why I think we are offering different propositions to people with different risk appetite. So for people who are able to sort of see through this volatility, we are happy to offer a very simple structure like the PMS, where we follow this pipe kind of investing approach. But for people who are a little more sort of conscious of the volatility that comes through in the intermittent periods, I think we are also happy to offer a similar strategy on the AIF platform. The product construct is very simple even on the AIF side. What we're saying is that of the 100 rupees that we receive from the client, we'll invest about 70 rupees in a long only pipe kind of strategy. The kind of stocks that I just talked to you about, right? Concentrated portfolio of maybe 20-25 names, very long-term investment horizon, and very market cap agnostic. So there's a good chance that a lot of them will come from the relatively smaller cap capitalization. But these, so this 70% of the money gets invested in these names, and then you don't sort of churn them basis your sort of asset allocation views or your views on the broader market trends. But for which we use a different asset allocation overlay. And I think on that, we have spent quite a lot of effort over the last 4 years, where we've tried to create objective asset allocation frameworks around how to innovatively look at market valuations, how to quantitatively capture investment sentiment, because when investors are euphoric, you should be cutting back on risk and so on. So how to quantitatively capture investment sentiment, how to sort of get one step ahead of the consensus on which way our earnings headed. So this three-pronged approach, valuations, sentiment, and earnings, is what helps us decide, take a top-down view on where whether it's a good time to increase risk in markets or decrease risk. So using that asset allocation framework, what we intend to do is this: that the first 70 rupees, which is pipe-like investment long-only portfolio, stays untouched. The remaining 30 rupees, we use derivatives leverage through, let's say, Nifty futures. And we basis our asset allocation frameworks in times when earnings are weak, when valuations are expensive, when investor sentiment is exuberant. You try to cut back on risk, and we've allowed ourselves the flexibility to go up to 70 rupees short through that 30 rupees of surplus cash that we have, right? So we can leverage that 30 rupees to create a short exposure of up to 70 rupees in Nifty, such that if you think of the net exposure becomes zero. So that 70 rupees long only portfolio is unaffected. There is 70 rupees of short exposure, such that the net exposure becomes zero. And similarly, in times where our models are suggesting that it's a great time to increase risk because valuations are cheap, because investors are too fearful, and because earnings are expected to improve, you then use the same 30 rupees to take long exposure rather than short exposure. So the way we are sort of looking at this product is that the net exposure can range from 0 on the way down to 130 on the way up. So that at some times you are sort of completely market neutral when you think that there is a big risk in the market. And on other times you are long to the extent of 130 to sort of also benefit from the subsequent market upside. But in this entire move from 0 to 130, the long only piece is completely unaffected, because there that journey is more about small caps of today becoming mid caps of tomorrow and large caps of day after. So any asset allocation views shouldn't change that confidence in that business graduating into the next league. But through Nifty futures overlay, you also make sure that you're mitigating the intermittent volatility that might come through. And again, that piece is not being managed through my or my fund manager's discretion. There are objective frameworks that we've put in place that help us decide that. I hope that makes it a little clearer.
No, absolutely. Now, things are pretty clear. I have understood the entire context and the construct of the product. The next question, that is subsequent to what Mahesh had mentioned regarding the, propositions on the debt side. You had mentioned, Mahesh, in your, talk regarding the gift city. Can you please explain to our audience the context of product structures originated from the gift city perspective, and how it benefits ultra HNI clients, and how is it competitive? And also do address a doubt that I have in my mind, because my understanding is that domestic investors do not have much relevance of that structure. That structure is more relevant for NRI investors. You kindly clarify these two doubts also. So particularly address this query. Mahesh, you're on mute. You have to unmute yourself.
Kamal. So I'll probably answer your second question first. So it is not that it's only for NRI investors and the other investors have nothing to do with this. This investment in AIF can also be done by domestic investors, provided there is a under the LRS scheme. So they need to have a minimum of $1 million kind of a net worth in the immediately preceding year, and subject to the limits which is there in the LRS, the domestic investors can also participate. Now, with respect to the gift city tax, the advantage of investing in this, if you invest in a normal, a debt mutual fund, typically your return is governed by two factors. One is the interest, and second is the capital gain. the added element, the two-dimensional added element to the investments in GIFT City are the tax as well as the currency depreciation. When I say tax, the tax for investments in GIFT City is at the fund level. So whatever money that the investor will get will not be subjected to tax under the Indian regulations. So what happens specifically in tax is the capital gains arising out of, say, derivative transactions, arising out of sale of bonds, arising out of investments in REITs and InvITs, in investment in other AIFs, all these are exempt from tax. Over and above that, any income coming from, say, government securities, bonds, they are subject to 10% tax. Any investment in IFSC listed bonds, they are subject to 4% tax. So whenever we are investing into these government bonds or IFSC listed bonds, they are having a lesser rate of tax as compared to what you would get. And also the surcharge is having a cap of 15%. Plus the health cess tax. So it is a very tax friendly say mechanism in which you can put your money in. So the fourth perspective is the currency depreciation. So here IFSC listed bonds are bonds denominated in dollars, and you have ability to also invest in foreign currency bonds. So these typically would allow your portfolio to be hedged naturally, so that any volatility in the rates, anywhere between 15 to 30%, your the return is hedged. Now, if you see the past performance, how the currency has performed against the dollar in the last 2 years, 3 years, so the rupee has depreciated in the range of 2 to 3% in the last 2 to 3 years. But going forward, things may not be the same, because the way QT is happening, the way the Fed is expected to hike the rates, and no, there will be a lot of answer given back by RBI. So those things will have to pan out to see how the currency would look at. So long story short, what I'm trying to say is this is going to be a four-dimensional approach, wherein not only the interest part, the capital gains part, the tax part, as well as the depreciation part. These are the ones which will determine how the portfolio is going to pan out.
Mahesh, can I interrupt for a minute?
Yes, sir, please.
Yeah, just wanted to clarify one thing. Mahesh has said that the investment is allowed through LRMS, which of course discussions are going on at the government level, but that notification has not yet come. So that's likely to come, but it's not there as on date. Yeah. Go ahead.
Yeah, sure, sir. Thanks for the clarification. So broadly, Kamal, this is what GIFT City has to offer, and the fund that we are looking at will be is going to be a mix of a strategic and the tactical call that we would be taking in. So participating in index derivatives, for example, we may not be putting investments into money market instruments, because then again it will go to 10% tax rate. But the same thing if we use index derivatives by buying Nifty and then selling the future, the same return you will get in a more tax efficient manner. So, and here a very interesting part is, it is not necessary that if your portfolio is having a higher gross return, gross yield would translate into a higher net yield. These four factors which I mentioned, it is quite possible that you may end up with a lower gross yield, but eventually it get converted into a reasonably better net yield. So once you play with the IFSC listed bonds, the foreign currency bonds, index derivatives, so these tactical calls that you put in the portfolio will determine how your dollar denominated returns will pan out.
So conceptually, another question which generally investors ask, because they are new to these alternative investment structures, we have tried to address the return part of products, where we are saying that the conventional products have a limited possibility of returns in a shorter period of time, like say up to 3 years, because markets are volatile and valuations are high and macro factors do play. And in that shorter duration of say up to 3 years, alternative strategies have a reasonable conduciveness to generate maybe superior returns. At the same time, let us address the risk part of it. What is it that from the equity side, when Gaurav has explained in the long short style of mid small and micro cap oriented fund, where obviously the idea is to ensure that the downside is relatively protected and at the same time upside is definitely attained. But if it is to be addressed from the and similarly, what you are mentioning with regards to the debt side of alternative strategies. So I want both of you to address for our audience, conceptually, if we compare these products to the conventional side of products, which obviously generate relatively, I would say, relatively inferior risk-adjusted returns. These are expected to generate superior risk-adjusted returns, but particularly from risk aspect, how should investor look at these strategies? Gaurav, to you first.
Yeah, sure, Kamal. So I think I briefly touched upon this aspect earlier on, which is that when we are offering these strategies on the PMS platform, they will sort of come with the usual volatility that a typical long only product comes about with. But I think just want to clarify once again that while we are very excited to express these relatively, or sort of in a way, we're very excited that we are not constrained by size, and as a result, very free in terms of existing market cap ideas across the market cap spectrum. I think what I also want to harp on is the fact that even when we are investing in small caps or micro caps for that matter, we are definitely not letting our guard down with respect to underlying quality of these businesses. And which is why, I talked about the fact that not only are we doing the full channel checks that we do with respect to meeting the entire ecosystem around that company and the management, we're also spending a lot of time on the ESG analysis, on the accounting analysis, on making sure that the governance is of the best standards and that the business is sustainable, not just today, but ideally forever. And that in turn will ensure that this business, which is a small cap today, graduates into a mid or large cap of tomorrow. So, which is why on the business risk point of view, I think we are anyways making sure that our due diligence is right up there. What we can't do much about is the market volatility risk, and which is why I talked about that long short offering on the AIF side. I think there investors should expect. I mean, at least we've done some of our own simulations and back tests. I think investors, without compromising on the returns that we expect from a long only portfolio, should expect perhaps half the drawdowns that you would otherwise see from a long only product. So in that sense, not only are we saying that we will not compromise on the return aspect, we're also sort of hoping that we'll be able to reduce the drawdowns versus the long only product. And this is even when we are largely investing in market cap agnostic ideas. So in that sense, I think the investor experience should be for equity like return with a significantly lower risk that comes along. This is on the local AIP because we all know that there is a decent degree of tax leakage that happens because of the high MMR on the derivatives transactions. We're also proposing a similar strategy, the same strategy, right, where you you have a long only portfolio, which is very pipe like investing approach, and then a long short piece on top of that, which is driven by our asset allocation framework. We're also planning a similar strategy on the GIFT City side. And there, I think there is a huge difference between the derivatives transaction piece, right, which is, from our understanding as of today, zero. So to that extent, there we are looking at the same product as not only being significantly lower in terms of risk versus an equity long only product, but it has the potential to also magnify the returns versus a long only equity product. So I think those are the three things to look at. A PMS is hopefully higher return than a long only product, or it's a long only product both in terms of risk and return profile. The local AIF is equity like with respect to returns and equity minus with respect to risk. The AIF, the GIFT City piece, hopefully is not just equity plus in terms of return, but also equity minus in terms of risk. Kamal, hope that sort of is what
absolutely perfectly fine. So I think this is quite comforting to understand both the risk as well as return side of it. And my question more comes from the point of view that I have been seeing over last 5 years. There have been many other big AMCs which were doing really well on mutual fund side, and they aspire to do great business in the space of alternatives. But in the very first 2-3 years, they had to actually change their strategies. But it seems that SBI has actually deep dived and understood, and you guys were waiting for long to see what is working, what is not working. And now, when the space looks to be really conducive and kind of things are more clear, and in that context, my question to Mr. DP Singh, that when you initially kind of very confidently claim that like SBI Fund Management is today a very well-known and thought leader in the space of mutual funds, there is a big vision with regards to the space of alternatives. So leaders shape and execute the vision, and you are a leader managing as a chief business officer the space of alternatives as well as mutual funds for SBI as SBI Fund Management. So it would be good to hear it from from you. What have been your learnings in the past, and why do you say that so confidently that over say next 3 to 5 years, SBI Fund Management is going to be leader in the space of alternatives?
Yeah. Thank you, Kamal. Thank you very much. My first response to what you are saying is, I think my voice is echoing, right?
Absolutely, this is fine.
Okay. So the first thing is we worked on this particular aspect for the last 2-3 years, and we could see the weaknesses. We can point out the strengths what we have, and thereafter we have decided to do it. The first and foremost was that while managing the alternatives and while managing the mutual funds, the thought process is totally different. So we have decided to verticalize it. We have now on the PMS side, as I told you, we have a very, very strong team which is taking care of only the PMS business on the institutional side. Now we have created a vertical. Mr. Gaurav Mehta has been designated as CIO Alternatives, and he has the very good experience on this side while working in Ambit, and otherwise the thought process is totally different. Now we'll have the complete business, and eventually we plan to have a subsidiary for alternatives. So that is the thought process. And we are sure that with the kind of reputation we have as a brand, with the kind of the network we have, I'm very sure that will be able to succeed. Moreover, the kind of reach we have amongst the people who really want to graduate from the normal simple products to some complex products where they can enjoy some better returns and they can have a different experience. I think we are very well set for that. And so we don't look at 200, 300, 500 crore kind of businesses. We have already built up our system businesses on the mutual fund side. On the ETFs, passive business, we are the leaders. On the active equity, we are the leaders. On the institutional PMS, we are the leaders. And I have no doubt with the kind of verticalization which we are doing, and you will hear from us about the structures very, very soon, that we are going to have an absolutely independent structure for the for alternatives. And there's no reason that we will not succeed. We are absolutely confident, and our investment in business is going to be very, very high because we have got a very strong investment team already, and we'll take the benefits of that on the private equity side, on the PFA side. We'll definitely invest in the businesses. We have the capability to do that, and there's no reason that we will not succeed.
My good wishes to you, and I think it has been really interesting, and we will be looking forward to all those products that we have discussed in terms of understanding more deeply when we see their product decks. And I'm keen to have one-on-one conversation both with Mahesh as well as with Gaurav, on their respective products for my clients as well as for our audience, because both these products look to be very interesting in their respective space. My last question, before we wind this up to Mahesh. Mahesh, your product category is going to be very interesting, and I'm telling you, there are going to be a lot of buyers for it because investors today are kind of struggling to get more than 4.5%, 5% return in the space of debt side of their portfolio. There are a lot of areas to venture out on the equity side. Investors today are crazy and investing with a lot of hopes into the pre-IPO side, hoping that the listed space looks to be expensive. Let us try to diversify to the pre-IPO space. And investors are obviously they have made a lot of returns even in the venture capital funds, and that is where also the action is there. At the same time, the long short and long only funds are also doing very well on the equity side, but the debt side is actually kind of, I would say, dry. And there are, if we were to see the overall asset allocation from the Indian investor perspective, from the context of the overall industry and AUM, the larger pool is towards the debt side. So your strategies are definitely, I can tell you there will be a lot of takers for it. Last words, you may want to set expectations for the audience in terms of risk, in terms of expected returns, because I can tell you, this side, everyone is more keen to know.
Yeah, Kamal. So in the mutual fund, say, space on the debt, no, we follow a principle, a philosophy which is called SLR, safety, liquidity, return. So having that perspective in mind and being more granular and following the same philosophy, there is something called CDLR, if I have to use that word. One is we probably may look at the credit evaluation. So when we evaluate credit, there are, in terms of the capacity, in terms of the character, collateral, and covenants that the underlying have to offer. Then we look at the duration positioning, which is the earlier one is more of a bottom-up strategy. The duration positioning is more of a top-down strategy. So when both match together, is then you take a call on the liquidity. So liquidity, whether how much market liquidity is available on that particular issuer, and all put together will eventually turn out to a particular rating. And the spread that you get, how you compare that spread with the rating, and whether you the spread that the market is offering compensates for the risk, both on the credit side, on the duration aspect, on the term spread, as well as the liquidity which is going on. So there is an element of governance which also gets imbibed into it, and that is how we try and build up the portfolio, try and take the credit calls, try and look at those strategic as well as tactical calls, and then make up the portfolio. So every issuer, every issue that comes out gets evaluated for the term, gets evaluated for the underlying rating, gets evaluated for the perspective that it is, it's the timely and full the return of money that we will get on the due date, and the ability to actually sell when we feel that the markets are good, or when we feel that the underlying ratings are there. So those things put into perspective makes us to manage our risk in a more systematic manner, keeping our mutual fund philosophy in place, and this being more granular in nature to look at specific deals that will come in the AIF space.
Right, Mahesh. Thank you for sharing your wisdom, and thank you, team, fund management, and everybody to log in today to this session. Before we end, I would just like to share with everyone that we at PMS AIF World are working every day with a lot of passion in terms of learning and educating our clients as well as the knowledge seekers, and we have been doing really good work in this context, because our whole objective is to actually help investors make informed investments in the space of alternates. And alternates are not easy and simple products to comprehend. And as we have gone through this entire webinar, there are definitely innovative or complicated structures, as we may call them, and that is what we call as a smarter asset class. We cannot call this asset class a debt asset class, or an equity asset class. It is somewhere in between, a smarter alternative investment asset class, and that is what is the new way, or a new, I would say, age of getting better risk adjusted returns in one's portfolio. We would definitely continue this exercise in terms of understanding better in terms of respective product strategies, both from Gaurav and from Mahesh. So I can tell you, you will hear from us, PMS AIF World, in terms of doing sessions with Gaurav as well as Mahesh, respectively. Once we have complete details of the respective products. Thank you everyone for logging in today. Thank you.
Thank you.
Thank you so much.
Thank you very much.